Hi, Jeff. Thanks for joining me.
Hey, Steve, thanks for having me again.
Good to have you. We're talking about last year property deals transactions volume being way down, but prices actually were not down that much. We saw just 374 billion of real estate sold in the last year, according to MSCI data. That's a 51% drop from 2022. Also lower than the 2020 of COVID, where you couldn't even like inspect the properties. This has really been driven by the higher interest rates, but at the same time, commercial real estate prices are down just 11% from the peak, from the top, when the Fed began raising interest rates. And while office is down in a market like San Francisco is down 40%, most of the market really isn't down that much. Apartments have come down. I think they've slipped about 15% from their peak. But e-commerce warehouses haven't lost any value at all. Hotels really haven't lost any value after being battered in COVID. They've kind of come back to where they were. Uh, and we're not seeing owners having to do fire sale prices or bargains really hit the market. Just want to get your commentary on this really big drop in transaction volume we've seen, but really not a huge drop in prices.
You still have a lot of debt that's coming due over the next 12, 24 months that is going to have some dramatic sticker shock. So I think prices will come down to offset the rate rate pricing. I'm just not sure if it's going to be just a cliff that everybody kind of thinks is going to be there.
Yeah, and I think this is just nuanced, and there's not one commercial real estate market. There's multiple markets, and we could be talking about geographies, but also classes. And the data kind of goes into that a bit where, yeah, San Francisco office has gotten hammered. And I'd argue a lot of that has to do with things very specific to San Francisco, including a real crime problem and a quality of life problem
For sure.
there. But then, like, you could go to somewhere like New York, and you're seeing like the high quality office hold up really well, and some of the Class B and C having trouble. So yeah, there's some segments that are having more challenges than other segments that seem to be doing well. The article mentions, e-commerce. There's certain segments of industrial that are just doing, very, very well. And then even when you take a look at properties that might be having challenges, that almost I think goes into two classes. There are the properties where the owner looks at it and says, uh, "This challenge is temporary. I can write it out." And
That's
then
right.
there's some where it's like, okay, this isn't a temporary challenge, but I'm going to try to restructure it with the bank. And then there's this other class where they're not going to write it out. They can't restructure it with the bank, and it actually will hit the market and get repriced. And that really seems to be a minority of stuff. And even when that hits the market, there's so much dry powder out there. I think, here's some data. Investors have raised 240 billion to take advantage of deals in the market. So even if you have a good piece of distressed property hit the market that couldn't do a bank workout that they didn't want to just hold and they thought it was going to get better, you get that kind of, minority case. There's still plenty of capital to jump on it and make it not have too much of a price decline in this current market. So, you know, I- yeah, we're talking. Yeah, there's definitely going to be some opportunities, some value, but the conditions right now just haven't been lined up for this big fire sale of all these, valuable quality properties hitting the market, with nobody wanting to buy them and being able to get them cents on the dollar. Is just
Yeah.
not happening.
Yeah. Look, I mean, the other side is distress is a um, easy word to get wrapped up in, right? You kind of hit it like what really defines distress, but distress on the side of the bank, there is, as a former lender, as a financier, or whatever you want to call it, I've managed workouts from the side of being a bank. You can do just about anything you need to keep a book on the, I mean, to keep a loan on the books so your balance sheet doesn't just drop off. And you could extend the amortization. You could drop the rate a little. You could drop the rate and extend the amortization. There's an infinite number of things that people can do. They can delay payments for 12 months and then put back up on the back end so you can get adjustments to it. There's all sorts of stuff. I think there's a lot, like I said before, there's lots unpacking this. There's a lot of nuance that you just can't touch on. I mean, and you hit one of them, San Francisco, where you have large footprint, tenants that don't need large footprints anymore. What do you do with all that space? So it definitely is market by market. It's there's variance, and there's still really good deals out there, and we're looking at a few, and I think that's kind of the point. The world isn't ending; it's just changing.
Yeah, and the other things I would add is, we topped interest rates with the 10-year getting to about 5% last October. Uh, and maybe if the Fed had kept cranking rates up, we get to that more place where you got a pretty bad recession, you've got a really high financing environment, you've got an environment where banks don't want to do workarounds, they just want to get out, or they're afraid to put in. I mean, maybe you get to something that's more like that kind of '08 conditions. Um, but so far we haven't, and we didn't, and then the rates eased up. So I think we're just still in this world where there's some bargains out there, but you got to hunt for them.
Yeah.
It's not just raining bargains, and that's not a bad thing that we don't have too high interest rates and a recession and everybody running for the hills.
Look, I think
It's a
I
good
think
thing.
you hit something there too, that I feel we should probably touch on is really just the main trigger in this article is really interest rates. So, as interest rates go up and property values don't come down, lenders are still going to lend on properties, but you're just going to have more equity in it. So even if the property only has like a 1-to-1 debt to income ratio, the only person who takes a toll there is probably your investors, not the lenders. So the lenders are saying, I've got lower leverage. I'm not in as bad a position as well. So,
Yeah.
and what do I mean by the investors? I mean, for some of these deals to work, some of these, groups had to get, not real investor money, but these kind of like in between mezzanine type debt structures to get there. And some of those will be the ones that are in trouble.
Okay, I appreciate the insights, Jeff. And yeah, if you enjoyed this video, give us a thumbs up, click subscribe for more. And thanks a lot, Jeff.
Thanks, Steve.